Iran's attack on Israel spooks the market, heightening geopolitical concerns even as the Russia-Ukraine conflict continues. Financials and utilities are the big drags, even as metals and energy eke out some gains. Mid-caps underperform.
IT bellwether TCS reports slower than expected revenue growth but delivers a positive margin surprise. The company tells CNBC-TV18 that FY25 is expected to be better and the evolution of AI remains a key factor in client decisions.
Aluminium and nickel rally after US and UK imposed new sanctions that ban deliveries of any metal produced by Russia after the 13th of April. Stocks of Indian aluminium majors perk up on the news.
A disruption in oil supplies due to a possible escalation of tensions between Israel and Iran keeps oil markets on edge as Iran is a major oil and gas producer. Stocks of Indian oil producers gain.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Mangalam Malu. Well, yes, it is turning out to be a down day for us and definitely because of the geopolitical concerns. But we have recovered. So we are up around 119 odd points for the Nifty from the day's low. So that's definitely a positive. But nonetheless, the advanced decline ratio could definitely do more work. It's around 3,000 stocks declining to around 857 stocks advancing on the Bombay Stock Exchange. So as the day goes by, there will be a couple of things that I will watch out for, Mangalam. One will be how the European markets open, because that seems to be center stage when it comes to the developed economies and what could be happening in terms of the geopolitical risks. So that would be crucial, and any kind of impact that we could see in our markets. And separately, any kind of improvement in the advanced decline ratio.
Take that point completely, Ekta. We're down but not out. And, on days like this, typically when there is global weakness, whereas the domestic factors are pretty strong, we see a recovery from the lows, and that has happened. But thereafter, towards the second half of trade, there is a second dip as well. So let's see whether that second dip comes by or not. And if there is any recovery from the second dip that we see in the market or not is the big question. As of now, the guardrails for the Nifty have been drawn 22,250 at the lower end, which is a little below today's low. And on the way up, 22,450 has been, a bit of a resistance. So that is something we'll watch out for, even as we're seeing some decline in a bunch of, parameters for the market itself. Let's watch out for the important data point that is flashing for you at the bottom of your screen. We had a bunch of macros come by on Friday, which was with regards to India's IIP and CPI. Yeah. But now we have the WPI inflation. After many months, I believe it's inched into positive territory, Ekta, 0.53 versus 0.2.
Well, yes, absolutely. But the WPI was expected to be 0% this time. It was expected to actually soften on a month-on-month basis from that 0.2% to around 0%. And in fact, it's come in higher or harder on a month-on-month basis. It's hardened, so 0.53% as compared to around 0.2%. But it's largely in line with our poll of around 0.6%. But there were some expectations that there could be a 0% figure which could come in for the WPI. Now, core WPI, let's see what that delivers, because it has been in deflation mode. So whether or not that kind of deflation would be to the extent that we've seen in the month of Feb. Remember that the CRB commodity index was up around 5.5% on a month-on-month basis in March, which was led primarily by energy prices. So what we're probably going to see henceforth is going to be the impact of energy prices on the WPI. But as of now, 0.53% versus our expectations of 0.6% versus some expectations of a softening, and versus 0.2% on a month-on-month basis. Remember that we did have the CPI data which came in on Friday, and that had moderated to 4.85%. It was a sub 5% figure. So maybe that there was expectations based on that maybe there could be an WPI softening this
We do
time.
have some more details as well. Food inflation, WPI food inflation is 4.65%. This compares with 4.09% in Feb. Manufactured products have actually seen a bit of a decline, minus 0.85% versus minus 1.27%. And we do have, the vegetable price index, which is up 5% on the month. Manufactured products, 0.2% on the month. Cereals up 0.4%. Nothing really in terms of move out there. But the outliers are food, and which is actually led by vegetable price index, which is up 5.1%. You did speak about energy. Well, fuel and power inflation has actually been a negative 0.77% versus minus 1.59%. So maybe this increase would be visible in the future ones, in the April month, etc. as well. So as of now, the details that we have, 0.53% for March WPI. This compares with the street expectation of 0.6%, and on the month it is from 0.2% to 0.53%. We do have Subodip Rakshit, who is the senior economist, Kotak Institutional Equities, joining in. With the numbers that we have, Subodip, what do you make of the WPI for the month of March?
Pretty benign set of numbers, and it has been continuing for a fairly long time now. Obviously led by the manufacturing product. So if you look at chemicals, if you look at basic metals, they have been on the lower side. And that is what is pulling down WPI and keeping it sub 1%. But I don't think that is going to continue. But at least for the March print, I think the manufactured products remain on the lower side. As you correctly pointed out, the food part obviously is on the higher side. We've seen that in CPI, we are seeing that in WPI, and I think that trend is most likely going to continue. But WPI on the whole remains benign.
Okay, well, WPI remains benign on the whole, but we do have commodity prices which are higher, metal prices which have risen. We have oil which is on the boil and geopolitical tensions to reckon with. At current status, what do you think the trajectory of WPI would be based on the current scenario of rising metal prices, commodity prices, oil?
Anyways, if we did not take into account the recent increases that we've seen in crude, etc., metal prices, the WPI inflation just on the base would have increased, and it would have increased back to around, let's say, 3.5%, 4%. But with crude prices increasing, obviously it has an effect on WPI. Not as much on CPI per se, unless the fuel prices are changed. But WPI, there is an impact that we will see on the fuel prices. Metal prices increasing would have an impact on the manufactured products as a whole. And that trajectory will now, as in WPI, let's say over the next 1 year, will continue to increase. That's what we expect. And that should increase to roughly around 4% by the end of the year. And that's broadly the trajectory that we are building in.
Okay, so you expect WPI to probably harden to around 4% by the end of the year. March WPI core deflation, it continues to be in deflation category, territory rather. It's at around a deflation of 1.2% as compared to 1.3% on a month-on-month basis. So that continues. That's an additional piece of information coming through. Well, Subodip, on the whole, what is your expectation now from CPI as well, considering that we are now working with a new scenario? And based on that, what is your expectation on whether we can see a sub 4% CPI inflation target through the year, and the expectations from the RBI as well?
Sure. If you look at the CPI, most of the weight comes from the food products, and the food products are not coming down as fast as one would expect. There's obviously a lot of headwinds in terms of food prices coming off, especially if you look at the kind of weather patterns that we have. We will have the IMD giving a forecast for the monsoon today. But overall, again, temporal and the spatial distribution matters a lot more in terms of how the monsoon pans out and what the impact on the food prices are. So that kind of remains a bit of the whole food prices remains in flux. And barring that, if you look at the kind of trajectory, there will be a sharp drop sometime around June, July, where there's a very favorable base effect that will push down inflation to around 3% or maybe sub 3%. But that's not a durable point that we see. What we see over, let's say, if you were to look at FY25, the average would be somewhere around 4.5%. Now, what does it mean for the RBI? For the RBI, the target is 4%. Obviously, given where we are in terms of growth, etc., the target for 4% remains, the RBI has been highlighting it. And we do not see a durable move towards a 4% anytime soon, which means that a pivot that we all, markets are expecting sometime in second quarter, third quarter, sometime around that. I think for us, we think that the RBI gets into a position to cut rates not before the third quarter of FY25, somewhere in the October or the December policy. That also assumes, in some sense, as per our estimates, that the inflation goes towards the 4% by first quarter or second quarter of FY26. So that's the kind of trajectory we are looking at the inflation. And hence, we think that the RBI will want to delay the rate cuts as much as possible to kind of anchor the inflation trajectory durably to the 4%.
Perhaps rate cuts ruled out for the next 3 RBI policy meetings itself. Subhadeep, I just wanted your thoughts on global interest rates as well, now that we have you with us, because RBI is also at some point, fixing itself with what the US Fed is doing. And out there too, inflation remains sticky. There are elections in the US as well. There are elections in India. Typically in election year, fiscal policy is looser than monetary policy. And at the same time, we have the new geopolitical tensions which may keep inflation on the boil. So would you assume that rates are going to stay higher for longer even in the US? When is the first rate cut that you're expecting out there, if at all?
So US for sure, if you look at the growth impulse as well as the fiscal impulse, they are on the higher side. Labor market data is on the higher side. The inflation numbers, I think, it's good to summarize it by saying that, the last mile of disinflation is clearly not very easy. And if you look at the credibility of most of the global central banks, that has been achieved after a lot of, putting a lot of effort. And they don't want to squander it away anytime soon. So they will wait it out as long as possible till the time there are clear signs that growth will be is an issue, or durably inflation is coming off as per, or closer to their targets. Till that time, I think it's very difficult for most of these central banks to kind of announce that they are ready to pivot, which means that, as the market is now pricing in, that rate cuts are not there till probably September for the Fed. And I think that's a very true assessment in some sense, given where we are in terms of the growth inflation mix, the fiscal policy, etc. I think it's for almost all central banks, it's now a wait and watch policy as long as possible. Rate cuts will happen if you see signs in terms of growth impulses weakening or inflation durably coming off towards the target. So I think that wait and watch continues for almost all central banks.
Okay, all right. We're going to leave it on that note. Pleasure talking to you. Thanks very much for joining in and speaking with us. So that's the update coming in on the WPI inflation data for the month of March, which is hardened on the headline at around 0.5% as compared to 0.2% on a month-on-month basis. And we have the core WPI, however, which continues to be in deflation territory, but is lesser as compared to the previous month. We need to take a short break. But up next, we'll get you more on the markets and a lot of stocks in focus today. So more on that once we're back. Welcome back. Well, for the Nifty, we're now down around 121 odd points. Mid-cap index is also down around 510 odd points. There's been a tad bit of an improvement in the advanced decline ratio. Let's see whether there's any kind of further improvement which is taking place. It's still quite wide in terms of the gap between the two. But let's now focus on the big story. TCS is in focus after reporting its fourth quarter numbers. On Friday evening, the company reported what was a big beat in margins and clocked in record deal wins. However, it missed revenue expectations. Our colleagues Prashant Nair and Reema Tendulkar caught up with the TCS CFO, Samir Seksaria, and the CHRO, Milind Lakhad, to discuss why the headcount, which moderated for the third quarter in a row, and if the strong margin performance recorded in Q4 is sustainable.
We are very pleased with it. We are touching a guiding beacon, and that's something which we have always believed in. If you look at, so that's a 100 basis point sequential improvement. And if you look at it, that's in spite of a 90 basis points headwind coming in from higher third-party expenses and increased travel expenses, which was offset by 190 basis points coming in from bottoming out of subcontractor costs and productivity and utilization gains.
So subcontractor costs have bottomed out?
We believe so. It's at 4.6%. That's 150 basis points lower than the previous quarter. I think now it would still depend on the macro, how it plays out, but we believe it is bottomed out and we should...
And what's the outlook on margins going ahead? Does it stay at 26% other than the wage hike quarter? Say next time, exit margins for FY25. Can it be better?
So let's be happy with what we have been able to deliver in FY24, and exiting Q4 at 26 is really special. We are happy with it. If you look at the past 3 quarters, we have almost delivered 100 basis points sequentially, plus minus, but 100 basis points coming in each of the quarters. So, and we'll continue our focus on disciplined execution.
You know, Kriti and NGS was telling us earlier that FY25 is going to be, and NGS said much better than FY24. So there is a bit of a operating leverage or whatever you want to call it, right? So margins perhaps could be better if growth picks up.
So definitely growth is a big lever on margins, and if growth picks up and is better, it will definitely accelerate the margin journey.
And do you think growth is looking, as you from your vantage point, is looking stronger?
I'm sure,
the year ahead is looking stronger?
I'm sure Kriti and NGS would have given you better color, but we believe FY25 will be better than FY24.
Milind, headcount is down for the 3rd consecutive quarter. You know, so do you think it's going to continue to moderate from here on?
Yeah, no, I think Samir talked about productivity and utilization. All of that stuff is all coming together, and plus our investment made in the past. All of that together coming together is what this result is going to be, right? You know, this is last quarter you asked me and I said, yeah, I will not be surprised if it is negative, and it is turned out to be a lesser negative number. So we expect to drive the same kind of efficiency going forward. Growth will come, we'll hire more, and then we'll have...
So to drive this efficiency, is it possible the next quarter again headcount declines?
No,
will you be surprised?
No. Then let me put it this way. I think it's a function of our efficiency, what we hire, how many we hire, and eventually what the business growth is going to be. All of this together, whatever that outcome will be, will be.
You know, Milind, the linear relationship between growth and number of people that you need, right? That has not been true for a while now, right? I mean, there's non-linearity. You can do more with lesser number of people.
If you bring in the time dimension into this,
it's still...
you can still relate to it. But our intent all along and our drive all along is to basically have a soft linkage to these two things.
Right.
Headcount growth versus revenue growth.
Right. No, my point was now with AI, etc. as well. Can you give us a broad sense? How many people that you potentially would have hired, you did not because of these new technologies? I mean, if you can give us some sense of that.
Prashant, it is too early to say that. No, currently we are in a POC mode. We are doing hundreds for POCs, actually 300 plus POCs we are doing right now across customers.
Sorry, POCs?
Proof of concepts. Proof of concepts. No, with our customers. All of that, and eventually coupled with all the other enterprise-related challenges, all of this will take some time to basically come to that point. So we will play and we'll obviously keep you posted as we go along.
But you don't think it's already happening?
It is not to the point of enterprise level changes at this point in time. We actually, customers are still testing out. Customers are still figuring it out basically how it is going to be all work out. How eventually the accountability of the software generated by AI, how it is going to be managed.
Because now you're saying that, I mean, if you talk to educators, it says they don't need to learn, kids don't need to learn coding anymore. You can tell the computer to write the code, ask it to do it, and it'll do it. So at a very basic level, simple, I mean, of course, you'll always need programmers and, certain set. But the vast majority, you think, this will be a challenge?
You will still, basically the role of the developer will change. The role of developer will change. There will be an, AI co-pilot which will work with you to get the job done. How will you get the job done from an AI co-pilot? What will you do? What is your role change that is going to happen is currently being reimagined in TCS and in the industry.
Samir, do you think peers may have dropped the margin threshold to chase growth? Is this something that you've seen in the industry? Not you, but the industry, your peers.
I can't talk about peers, but I think we have always believed in growth with profitability. We'll never let out an opportunity for growth at the cost of profit. I mean, just because of profitability or margin thresholds, or nor will we chase growth just for the top line, which does not do a value add for the customer, for us as an overall enterprise.
Okay. And Milind, you know, on demand right now, so far you're able to manage the current demand with a lower headcount, which is what's driving your utilization, productivity, etc. When do you think the company will start hiring to meet demand, which you can't meet with your existing
We already are
employees?
hiring. We hired a whole bunch of
But
numbers.
the net headcount is falling, right?
But you know, the point is we are hiring this now. The point is big numbers are hiring. There are people who are leaving. The point is just net headcount is dropping. Eventually, you know, when the like he says, as the business start showing more positive signs, then we are anyway going to ramp up like we always do.
Is this going to be just-in-time hiring, or you think there's already slack in the system?
We do. There is already slack in this. There is always some slack in the system, right? We always keep that slack.
So it's not necessary if growth picks up in 25, it would be a net positive number on the hiring front.
No, it can be, and there's a very high chance of that it will be.
It will be.
Okay. I mean, at what point of growth do you need to start hiring? I mean, if I can put it that way.
So you mean to say we are anyway hiring Prashant?
At a net level, sorry. When will that net number tick positive?
Yeah, I expect it can happen as early as next quarter.
Okay. Because the assumption is that if growth is going to pick up 2 quarters down the line, you need to hire today and train them so that when demand picks up 2 quarters down the line, they're ready.
So let me just put it this way. From campus, we are the first ones to go to campus. You know, we already basically gone to our priority institutions and made, tens of thousands of offers.
Okay.
We already started NQT, our phase has started. So all of that is proactive. Now, from the market, from experienced talent which we get every quarter based on the required demand.
What's the fresher addition that you're planning for FY25?
So, it is hard to give the number right now.
But you always give us a number, right?
I give a number of 40,000 every year. 40,000 every year. I don't expect that number to change significantly this year. But I cannot tell you exactly what that number will be.
Right, that is the management of TCS. The stock is just about middling around the 4,000 rupee mark, and that was largely expected because of the call writing that had taken place out there. Numbers better on the margin front, the management optimistic about next year. Let's see where it goes as well, given the global context that we're currently in. Take a short break, come back, focus on the markets once again. The Nifty hovering around 22,400. Ruchit Jain will join in with some trading strategies. The Nifty is still down about 120 points from Friday's close, but a good 120 points above today's low. 22,400 is where we're at. The Nifty Bank still sitting with a cut of about 1%, and the mid-cap index not doing too well with a cut of almost 1% as well. But today's low extremely important, largely because it also coincides with the 20-day moving average of the Nifty. So if you look at today's low on the Nifty, 22,264, largely photographic with the 20-day moving average of 22,270, and from there we saw a bit of a recovery. So to that extent, this remains a sacrosanct mark now for the market. Top gainers, it has to be from the commodities, energy/metal space. So ONGC up 5%, Reliance up 0.83%, but from the lows it's up nearly 2%, and that's resulted in the Nifty recovery that we've seen by virtue of its weight. Hindalco is among the metal stocks which are doing well as well. What is the key to watch from here? The advance decline ratio. At around 1030, we had 250 stocks advancing. Now that number's nearly doubled to 430 stocks. And the number of stocks which were declining were close to a little over 2,000. And now that has come to around 1865. So those lines coming closer is something we'd like in the second half of trade itself. But for the Nifty, it's made a range for itself. 22,300 put, which is pretty active, tells you that today's low of 22,264 and around 22,250 would be an important support for the market to work with. And on the way up, it's the 22,500 mark, which is extremely active. That's because the 22,400 call is equally active, and we're seeing a 100 rupee premium on that. So 22,400 plus about 100 brings you the resistance for the day. A lot of long positions being added on gas-based stocks. So we have IGL, MGL, Gujarat Gas, all of them higher with a lot of open interest build up backing them. And just keep an eye out on Exide and SAIL. These were the stocks that came out of F&O ban on Friday. But with the kind of open interest activity that we're seeing in both these names, they may well re-enter F&O ban today. So to that extent, these will be in focus too.
Okay, all right, Mangalam. Thanks very much for that. So that's the update on the F&O space. Ruchit Jain joins in to discuss the technicals of the market now. Ruchit, hi, welcome to the show. Well, interesting market, good recovery on an intraday basis. Would you buy into it?
Yeah, hi, very good afternoon, Ekta. Very good afternoon, Mangalam. Well, we often see that markets we have witnessed a gap up or gap down opening based on overnight news. But what is more important rather than gap is the follow-up move, and we have not seen any kind of follow-up selling, majorly post that gap down opening today. So I think markets are into some corrective phase, but that correction is not a much of a price-wise correction, but it could be more of a time-wise correction where the index would form a range of 22,600, 700 on the higher side and 22,300 to 200 range on the lower side. And we believe that till this uncertainty is over with related to this geopolitical tensions globally, I think there would be some time-wise correction only. So whenever markets are in time-wise correction, better to focus on stock-specific approach. We can see that in spite of markets doing negative, a lot of sectors or stocks are there which are showing outperformance. So in case if one has to trade in the index, then look to buy on dips around lower end if you get it in that range of 22,300 to 200. So the risk-reward ratio becomes favorable. But don't expect any big up moves as well. 20 to 500, 600 could be a range where profit booking also should be done.
All right, and individual stocks, how do you play that?
So Mangalam, couple of buy recommendations. So oil and gas is one space where we are quite positive. You can see stocks from this space have witnessed an up move supported by very good volumes in the cash segment, and also open interest build-up has been seen in the future segment. So both the recommendations from this sector. First would be a buy call in ONGC. Last 1.5 months, the stock has been into a sideways range, which on a longer term chart just seems to be a time-wise correction within an uptrend. Prices are on the verge of a breakout. Look at today's volumes in this heavyweight. The entire last few days average volume was surpassed in the first hour itself. So clearly shows that it could resume its uptrend. So even though it's up 5% today, but still has a good potential from current levels also. So traders can go long with stop loss below 270, expecting targets 300 and beyond in the near term in ONGC. And Petronet would be my second pick from oil and gas space, where the previous swing highs has been broken out. Again, same good price volume action on the breakout. The earlier resistance is acting as a support on any kind of dips now. So Petronet also has a good risk reward ratio favorable to go long over here with stop below 295 for potential targets in the range of 340 to 350.
Okay, all right, Ruchit, we're going to leave it on that note. Thanks very much for joining in and giving us all of that perspective on the technicals. Well, we do have the Vodafone Idea presser, which is ongoing. The CEO, Akshay Mundra, is speaking about the FPO. So let's cut in.
First, in terms of an overview, Vodafone Idea has a large pan-India network. It has got strong spectrum holdings. It has got about 439,000 broadband sites and about 298,000 kilometers of fiber. In terms of scale and reach, we have 215 million subscribers, 487,000 towns and villages where we have our distribution reach. And with our network, we cover 1.2 billion of our population. We also have advanced technology which is supporting a good customer experience and for which we have received several recognitions and awards over the years. First, let me talk a little bit about the spectrum. As I said, we have a competitive spectrum portfolio. You could look at the spectrum portfolio through different cuts. We have presented 3 cuts here. One is spectrum excluding 5G per million subscriber base, spectrum excluding only the millimeter wave, which is not likely to be used soon, per million subscriber, and 5G spectrum per 4 million per million 4G subscribers. And whichever way you look at it, you will see that we have a very competitive spectrum portfolio. We have 5G spectrum in 17 of our priority circles, which account for 98% of our revenue. And with this round of funding, we will roll out our 5G network also. Now, what is Vodafone Idea's strengths? Firstly, it is a trusted Indian brand with a legacy of 3 decades of operations, successful operations behind it. And the unified brand carries the power of 2 very strong erstwhile brands, Vodafone and Idea, into one. We have an extensive reach operating in 487,000 towns and villages, as I mentioned earlier. More importantly, we are covering 95% plus of the districts through our distribution reach, and that provides for a strong platform to reach the customers and to acquire the customers. In terms of digital assets, we have multiple digital assets, We app being the most relevant here, and I'll talk a little more about the app as we go forward. And we have a very strong proposition today where our gross adds share in the market is more than our customer market share, and investments in network coming out of this funding will enable us to improve that and participate in the industry growth, which has not happened in the last few years. Before I get into the industry, let me talk about our strong parentage. VI has strong parentage of two promoters, Aditya Birla Group and Vodafone Group. They have invested significant capital into the company. If I were to take what has happened over the last 5 years, a total of about 30,000 crores of equity has been invested, out of which 23,000 crores has come from the promoters. And as you would have seen the announcement, the preferential issue of another 2,000 crores has been committed by the promoters, which is of course subject to shareholders' approval in the next month. In addition, Government of India is a large shareholder in the company. Current shareholding is at around 32%. You are all familiar with Aditya Birla Group. It is a global conglomerate which is having a presence across 40 countries. I believe everybody is familiar with Vodafone India, but many people may not know that Vodafone, as a telecom operator, is the largest pan-European and African telecom company. So now coming to the growth opportunities that exist for the Indian telecom. I'm not getting into the India growth story because I think all of you understand the India growth story more than I do. So I'll not talk about that so much. But if we look at the Indian telecom story, it has the country has a large and a growing population, and ARPU, as we can see from this table, is one of the lowest in the world. If we look at a comparable economy like China, China is at $6.64 and India is at $2.08. So we are less than 1/3 of where China is today. So ARPU growth, ARPU improvement is one of the main drivers of growth. What are the other major macro parameters which kind of provide a clear indication of the growth potential? One is that 4G penetration is still at 66% only, and this figure for China again is 116%. So a lot of penetration to happen on the 4G, and if we look at the overall telecom penetration itself, it is only at 83%. And there's a lot of runway left for this penetration of 83% to grow further. And what is important in the Indian context is that wireless broadband still remains the main source of broadband across the country. So we've seen that fiber to home has shown some growth, but essentially the broadband needs of the country are today being met by wireless broadband. So that will be an important factor of the growth of the sector going forward. Now, if we come to the digital India, we all know that the government and the country has a vision of digital India which should grow. A lot has happened over the last few years, and telecom infrastructure will remain the backbone of digital India. The most telling statistic of the proliferation of digitalization or digitization is that the UPI transactions over the last 6 years have grown 750 times. And one of the important things is that UPI is again an application which almost each and every customer or citizen needs. And I would say that is a strong factor which would augur well for the penetration of 4G to grow from 66% upwards, because without a 4G coverage, you will not be able to do a UPI payment, which is a very convenient way of transacting today. While UPI is the most telling statistic, the other areas which are driving this growth are e-commerce, increasing smartphone penetration, growth of data centers, and in general, you are seeing that the data is kind of exploding all across the country. through various applications. The other thing which is very important for any industry and any player in the industry to do well is the industry structure or the market structure. You're all aware that we were in a situation where we had 10 or more than 10 private players at one time. The Indian industry was very competitive at that time, but the challenge was that with so many players, they were sharing a part of a pie where no other country in the world had so many players. Since the last 5 or 6 years, we have consolidated to 3 players, and we right now have 3 private players, of course. We also have BSNL as the government player. And so I would say this is the right market structure for the industry to leverage the opportunity and move forward. We have seen that while this consolidation was in the works from FY16 to FY19, the industry saw a shrinking of revenue, of the industry revenue, by around 18%. But from FY19 to FY23, we have seen a rebound where the growth of the industry has come to a CAGR of 13%, which is a very positive sign. And so all the points that I mentioned earlier, growing population, need for penetration, growing digitalization, all these augur well for the growth of the Indian telecom industry. So then moving on from the industry to Vodafone Idea strategy. First of all, I would say that we've had this strategy for some time. We were not able to execute the strategy because of lack of funding. In the interim, when we were not able to invest as we would have wanted to, our focus was to ensure that we provide the best services to our customers wherever we have a coverage of network, while we had kind of given up on the ambition of expanding the network, particularly the 4G coverage at a time. But we continued to invest, and you would see here that we have been able to provide a very good 4G service wherever we have been operating. And this has enabled us to grow our 4G subscribers over 10 successive quarters, quarter on quarter for the last 10 quarters. Now, with the proposed funding plan, we will revert back to our original articulated strategy, which has got 4 pillars. The first pillar is focused network investments to drive coverage and capacity expansion. Here, our investment will be focused on our 17 priority circles. The second pillar is ARPU improvement and customer retention. And there, I would like to give you some data points. First is that the ARPU has increased by a CAGR of over 13% over the last 2 years. And we have seen also an ARPU growth for Vodafone Idea for 10 successive quarters, every quarter on quarter. So as we invest in 4G growth, 4G capacity, and 5G rollout, we believe that we will be able to participate in the growth of the industry. And another focus area under this pillar would be continue to drive the digitalization of various internal and customer-facing processes. The third pillar is focus on business services through telco to techco transformation, and I'll talk about this in the following slides. And the fourth pillar is focus on strategic collaboration to leverage digital opportunities. And again, this we'll talk about more in the coming slides. In terms of the first pillar, which is focused investments to drive coverage and capacity expansion, I must say that one of the highlights is that I mentioned that while we were not able to invest in expanding our coverage, we made sure that wherever we were operating, we had a good customer experience. And you would say that in the last 4 years, our data capacity has increased from 25 petabytes per day to 82 petabytes per day. So we have continued to invest in capacity growth to address the growing traffic demand of our customers wherever we were having a coverage already. So, as I said, that we are focused on the 17 priority circles, which account for 98% of our revenue and also 92% of industry revenue. On 4G, we will invest both in expansion of coverage and in increasing capacity as the traffic grows with the increasing demand. In terms of 4G, we will also be rolling out 4G on 900 megahertz, where also we had started investing, but those investments were curtailed due to lack of funding in between. On 5G, we intend to cover 40% of our revenue base in the next 24 to 30 months. And we will also focus on small cell deployment in large metros and cities, because that makes a lot of sense there. So this would be our overall investment hypothesis. Now, one of the important things to understand, and this is very critical, is that while we have not yet invested in a 5G network, we have a network today which is built on 5G ready architecture. And if I were to give you some of the highlights here, in the radio side, 90% of our TDD radios are 5G ready. All new basebands which we have procured over the last 3 years are 5G capable. We have completed the 5G MRO obligation in 4 circles. And in our testing of 5G, wherever we have done, we have achieved speeds of 9.8 Gbps. So the testing has been done, and we just need to start deploying based on the tests that we have already done. In terms of core, we have a pan-India 5G NSA capable core network. And NSA, as you may know, is a non-standalone. 5G has 2 kinds of rollouts, non-standalone and standalone. Our network is today, the core is capable of doing a 5G NSA rollout across the country. On transmission, 90% of our optical endpoints are 5G ready. And we have also done IP intensification in our major cities, which again is a requirement for 5G. Moving on to our second pillar, which is build customer preference and trust. As I mentioned, this brings the strength of 2 erstwhile brands, Vodafone and Idea. And I'm sure all of you remember the Pug, the Zuzus, the What an Idea Sergi, and the Honey Bunny tune. And I do believe that we have a strong brand and a very strong brand royalty, which will further help us to grow as we get back to investment. Our latest campaign, Be Someone's We, has also evoked a very positive response from all the consumers and the larger audience. And we will continue on this very successful journey of creating a strong brand and generating brand loyalty. Next in this is the ARPU growth. Now, as you would see that today, given the lack of our 4G coverage, 42% of our subscribers are still 2G subscribers. This is a bit of a reason why our ARPU is lower compared to competition, but this also provides us a big opportunity of improving the ARPUs by upgrading these subscribers. And as has been shown on the right side, today if you see the ARPU improvement when a subscriber moves from the non-ULD or the non-unlimited data category to the unlimited data category, the ARPU improvement is 3 times. So that is a strong opportunity. And besides this, we also have opportunity to drive the ARPU by way of additional content being sold, additional agencies, which is becoming a big market as telecom becomes the largest vehicle of digital distribution across the country. The next driver of ARPU growth would be to say that the tariffs have been below a level where the industry can return its cost of capital. As I mentioned earlier, Indian ARPUs today are the lowest in all major countries in the world, and 1/3 of China, which is a comparable country. As you would see from the graph here, the data usage has grown by about 82 times over the last 7 years. The voice itself has grown by about 2.6 times over the same period. However, the ARPU has grown only by 1.24 times.
Well, that is the management of Vodafone Idea addressing the press to talk about their 18,000 crore rupee fundraise via a follow-on public offering. The key metrics being it's a strong brand. Secondly, the average revenue per user in India is the lowest in the world. So as a result of which, there is a fair amount of growth headway out there because the Indian tariffs have been lower. And at the same time, coverage of 4G has been 66% as against 116%. So some money would do well for their balance sheets is what they're saying. And as a result of which, they will grow, the brand Vodafone, which has been languishing and losing users for the last many months, as the TRAI data would have indicated.
Yes, and very interesting statistics which were actually brought out by the management. For example, in the last 5 years, they've seen an equity infusion of around 23,000 crores and by promoters out of the total 30,000 odd crores. The China ARPU stands at around $6.64 versus India, which is at around $2.08. And the 4G penetration is at 66% in China versus is at 66% versus China, which is at 116%. So that's the amount of potential which is there in our market. Let's see where we go from here.
Let's see where we go from here, and let's see whether Vodafone Idea can go ahead and capture that or not, given especially, you know, the large competition coming in from players like Reliance Jio as well as Bharti Airtel, and the impact of 5G as well, whether people will go ahead and subscribe to 5G, and what Vodafone is doing to go ahead and invest for that too. But what we'll do is take a short break. On the other side, we talk about all things commodities, because that's been the space on the boil since morning. Peter Maguire, CEO of Exim Australia, joins in with Manisha Gupta.
Markets recovered from the day's low, and there's no incremental selling which is taking place at this point in time. So that's definitely a positive. Well, before that, just want to point out Spark, which is basically one of the key stocks for today, considering that they are going to be holding a call which is going to take place at 5:30 p.m. this evening, or rather 4:30 p.m. this evening. They are going to be discussing the early Parkinson's disease molecule, which actually failed the studies that they were doing on it, and hence that is going to be important, considering that the stock has lost considerably since that piece of news. It's locked in lower circuit today as well. I think it's been 3 down days continuously for Spark since the news came out, so it would be important to watch overall. But for the markets, otherwise, for the Nifty, 22,374 is where it's at, and the Sensex is down around 500 odd points. I think we can take a short break, but come back with commodities. Manisha Gupta will be with us next.
Welcome back, and joining us on the show now is Peter Maguire from Exim Australia. Peter, hi, good to have you. And there's just so much happening every single day. There's no dearth of news or events, really. I want to start with metals right now, because aluminum clearly is on top game with 5% of gains after US and UK have talked about banning metal imports and, of course, delivery on exchanges as well. Has the sentiment already played in? Is the news factored in, or would it still be a buy in metals from here?
Well, good afternoon, Manisha. I think, you've got to say it is baked in to some extent, but I think that's still very much on a bull run when you're looking at the likes of, and you roll it across its little brothers like copper, nickel, lead, zinc. They're all having a nice run. So I feel as though that there's probably far more upside to go. It just seems to be very strong and, hard to find a ceiling. So at the moment, hold on and hang on, because I think there's further to run.
What are you most bullish on when it comes to metal? Because we saw the rally start with copper, and then zinc ran up, and now it's aluminum. There's some support that we've seen in iron ore. Even steel is trading higher right now. But if there is something that you would pick up as most bullish, what would that be?
I've got to say it's probably going to be copper, Manisha, because I think just from a global demand picture, and also it's had a dramatic rally at 9,500 a metric ton. I'm keeping a very close eye on the whole complex, because as it starts to gain even further momentum, I think a rising tide lifts all boats. So yes, I noticed that as far as iron ore. I'm conscious on the steel market, and I think overall aluminium's great. I mean, don't cut me wrong, because I think it's got probably plenty of upside as well. But I just feel as though copper, a wonderful barometer as far as the whole complex.
The weekend also saw a lot of geopolitical tensions come in, whether it's from Iran, Israel, and the kind of statements that we heard from Russia as well. And we did see a sentiment play up and then see profit taking as well, whether it was precious metals or energy for that matter, both trading off its highs, gold especially, which is almost $100 from the all-time highs that we saw the prices trade in. From here on for this week, what would you want to watch out for?
Well, I've got to see, first off, geopolitically, Manisha, where Israel, whether it sits on its hands or there's going to be some form of retaliation. I feel as though that we're probably nearly at half time. I mean, it's in their court and they're going to play it. So if they play it aggressively, then that's going to change the whole footprint as far as, Middle East tensions. If we don't see anything, then you could see a little bit stripped out as far as price for crude and possibly gold take a little bit of a, maybe wash out a little bit further. But, it's a wait and see game. I noticed something happened in Karg Island only a matter of hours ago from Iraq. There was talk of that. So there really is. It's starting to warm up as far as geopolitical pressure, and it's a wait and see approach. And naturally, what impact that has to traders' sentiment and whether you buy or sell, Manisha.
So when it comes to gold, well, we almost did 2,450 and we're trading at 2,355 right now. So it's nearly $100 of a decline from there.
Yeah.
Would you say near-term targets have been met? It's been overbought in any case. But from here, if there was a new investor wanting to come into this market, what would your advice be?
Well, first off, any market that runs up as hard as it did, it gets exhausted to the upside. It's like running out of steam. You're running for the tram or the bus or the train, and you need to take a break because you had to sprint 100 metres. That's what it was like. And it's just having a breath, and it's giving back some of those gains. I'm sure it'll find some form of support, maybe a little bit lower, but I feel as though that's the point. The second one is, I still think, and everyone's got their own mind's eye, that there's further upside for the gold market, very much so over the rest of the year. So, don't discount it heavily at the moment, Manisha, because it's just having a little bit of a holiday, a bit of a break for 24 hours.
All right, got that, Peter. Thank you so much for joining us. So do not mistake this correction for a further decline. It's a bit of a holiday, as Peter calls it, an accumulation in metals and precious metals is perhaps you should be looking at. But that's all the time that we have on HTR. But coming up is Business Lunch for Almost Action.